This is Brad Wolff, and this is the end of day Emini review for August the 10th, 2022. As you can see, Al marked on the chart, today was a lower low double bottom that had a buy climax forming a trading range. We had two lows, which the second low was lower, creating a lower low double bottom with this low. We had a rally and a buy climax that was also a bull trap that led to a trading range. You can also call it a trending trading range day, or where you have a lower range right here, a bull breakout followed by an upper range right here. Now, a few pieces to note before we talk about the stop entries is that the market gapped up high. And if you were in the trading room, which Al and Rose currently present in, you can find more information on that on the brookspriceaction.com website. If you were in the room today, you would have heard Al mention that the market gapped up, and on these two big bear bars, that significantly lowered the chances of the day being a trend from the open trend day or bull trend day, which increased the odds of the market being in a trading range. So bears, they could sell below 1. However, even with bar 2, they can also sell below that. If they did, some bears would get out above this bar or a couple points above. Others would get stopped out above here. Now the problem with that is if these two bear bars greatly favor the chances of the day being a trading range. So if you sell below here, or you sell below here, sell this low, you really don't want to get stopped out up here because it's going to be the top of the trading range. But if that happened, traders could get stopped out there. Maybe they sell again below here. But, then what do? They buy back here, buy above here. That's really difficult. And it's also difficult to sell this low and exit as the market's turning up. So this is a trading range. And trading ranges will always punish stop entry traders, especially those who don't use a wide stop and scale in. So traders would sell this high, they'd sell more higher, get out break even, they'd buy this low, they'd buy more lower, get out somewhere up here. If they didn't get out up there, they'd buy more down here and put a stop below this low and get out up here. The market almost became always in short, so some bears will sell betting on a bear breakout, which would be a double top. Here's the neckline. However, with this being a bull bar, that failed to make the market sell the close. Consecutive bear bars, yes, bears really needed one more bar. And if they needed one more bar, bulls are going to buy. The bears selling here are going to scalp out, betting that those bulls do not get one more bar. Bulls, they can buy here, double bottom. They'd buy above this high. They could buy above here, this inside bar. It's possible wedge, 1, 2, 3. Tight enough channel, probably going to get a second leg. This was a surprise bar right here. And although it was big, the odds favored sideways. So traders, they really needed to see consecutive bull bars. And with this bar, the follow through being a doji, a lot of bulls would get out betting on 2 legs up. Leg 1, pullback. Leg 2, you can call it a bull breakout of a double top. It doesn't matter. If this is a trading range day, then the market could easily test all the way down to here before it retests these highs up here. So it puts the bulls in a difficult situation. So any bull that's long, they really need to stop below here, but probably lower than that. So a lot of traders would get out below this bar or a few points below and look to buy lower. Aggressive bears can sell, and if they did, some will scalp out, disappointed with this bar, disappointed here. Others, maybe they get out back at break even, some would hold. Most bears would get out above this bar. Aggressive bulls would buy. If you did sell below here, you're really betting on a test of this gap right here. So there's going to be buyers here. Bears sold right here during this bar. They're disappointed. They're going to buy back shorts back at this low, which means bulls are going to buy down here. Bulls, they bought this close. They're going to scale in lower, and when price gets back to it, they will sell out of longs. And that happened for the rest of the day. As it goes lower, it sells off. 2 or 3 legs down, bulls buy. A couple legs up, double top, bears start selling. Second entry short, bears will sell, and bulls bought down here, bad follow through here. The bears didn't do enough for always in short, so they bought. Second entry buy, bottom of a trading range, possible higher low double bottom. Bulls will buy, hoping for a rally into the close. Overall, trading range day, lots of limit order trading. Overall, it's really important not to be hopeful on this kind of a day. As Al often says, when you see a breakout, breaking above the range, and bad follow through, assume the breakout's going to fail and go sideways. When you see a bear breakout and the market's trying to get strong, assume there's going to be something wrong with the bears and the market's going to fail. If you liked this video, please check out the brookstradingcourse.com website, where you can see more blog posts and find more information on the Brooks Trading Course. Thank you for watching.